My next guest says the big surprises this year could be better growth numbers and cyclicals taking a leadership position. Here with us is Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. Savita, always good to see you.
Hi, great to be here.
So, discretionary?
Yeah.
Retail?
Yep.
Travel? What else?
Yeah, travel I think maybe a little less so, but I mean, my sense is that the world is not, and investors, professional investors are not prepared for a positive growth surprise. They're prepared for almost every other tail event or tail risk. Like when in meetings I hear talk about the most dire scenarios, you know, U.S. debt defaulting again, the civil war in the U.S., but nobody is talking about the fact that we keep revising GDP higher and earnings are still surprising. I think that's the crux of it, is that we're still in this wall of negativity, this wall of worry, and folks are hiding out in certain themes like AI, which has obviously, you know, been a great story, but I think there's more to go in terms of GDP-sensitive companies actually coming back to life.
Yeah, we have seen little glimmers of hope within retail, despite some of the commentary. I mean, if you listen to the Lowe's earnings call, they were very cautious in terms of the state of the consumer, saying DIY will remain under pressure, et cetera, et cetera. And yet the stock was higher, and I thought that was sort of interesting price action there. And we're also seeing sort of signs of life in biotech recently. Where's the money coming? Is the money coming out of Mag 7? Are we finally willing to say, you know what, we're going to look for quote unquote value pockets in the market?
Yeah, I think it's coming out of tech, it's coming out of TMT in general, but I think it's also coming out of more defensive areas of the market. I mean, what's interesting is if you look at the average portfolio manager or the average mutual fund, their beta relative to the market is the lowest we've seen since 2008. And so beta, what is beta? It's a bet that the market's going to move higher. Nobody's got a bet on that the market is going to move higher. And I think that's what's so interesting, is that we're in an environment where even though, you know, folks are talking about how sentiment is so bullish and, you know, everybody is already invested, when you look at actual asset allocation, pension funds have the lowest allocation to public equity we've seen in 20 years. So I don't think we're in this, you know, bull market where everybody is euphoric on stocks. I think there's a couple of stocks that everybody loves, but the rest of the market is forgotten.
It's weird that we were also recession focused. I guess that's what happens when you raise rates. You think that it's coming.
Very quickly, yes.
And now we're surprised that the United States is such a great economy. We should always have the best economy. We should.
We should.
Now, my question now is that, do you think any of what we're seeing is related to either the infrastructure spending? Are we doing much of that yet? Have we really deployed it? There was the CHIPS Act, there was the IRA, there were all these things that we did.
Right.
Is this a result of those? The other thing I think is that we flipped the House, and the country did in 2020. Nothing new has been done.
Right.
We haven't spent anything else.
Exactly.
We're totally gridlocked.
Yeah.
We're just waiting for November.
Exactly.
Sometimes I think you just leave the U.S. economy alone, and this is going to happen, right? We haven't done anything
I think you're absolutely right.
Which is right? Are we benefiting from the programs that we did?
There's a bit of a boost. I mean, the fiscal impulse has contributed to GDP growth, but I don't know if it's contributed dramatically to earnings growth for the S&P. I think earnings growth for corporates has been driven by really effective cost management, by some efficiency gains that we're starting to see. Companies were spending on automation and efficiency since 2019.
That was your productivity?
That was our productivity thesis. Yes, thank you. And it's starting to play out in surprisingly stable margins. I mean, think about it. We've had 9% inflation over the last 2 years, but margins haven't really been rocked by that. So I think that's testament to corporates actually doing pretty well when you leave them alone and just let them figure out their business models.
I'm trying to figure out how we're going to screw this up. I guess the election could screw it up.
The election is a big wild card, but I think the positive is that both sides of the aisle are pro-economic growth, they're pro-manufacturing in the U.S., and I think that's actually very bullish for cyclicals. So, you know, which cyclicals are going to benefit under a Republican versus Democratic win, or, you know, that's a different story, and that's starting to be expressed, I think, in the market. The one sector that I would stay away from on political risk, just for, you know, the next few quarters, is healthcare. Healthcare is the most crowded sector in the S&P 500. It actually has higher refinancing risk than we all would imagine because the companies have done a lot of debt deals. And it's the most government-exposed sector in terms of fiscal spending. So if we do see fiscal austerity on the table, that's one area where we could see
now regulatory. There's a front page today. The DOJ. We're going to talk to Scott Gottlieb about that too. If you do want to do some things to sort of game the system, healthcare is a damn good place to be. You know what I mean? I mean, you can have, own a doctor's group here, and they're self-referring to their imaging center over here. I mean, if you don't watch them like a hawk, and you wonder why a lot of our inflation over the years has been healthcare. The aging of the population too.
Yeah. I mean, I guess I just wanted to make
it's ripe for some margin compression, probably.
It is. It certainly is. It's been it's had a great ride. I think the one bear case that I hear a lot that I want to try to debunk is just the idea that the market is too expensive. And folks will take today's S&P and compare it to 10 years ago, 20 years ago, 30 years ago, 40 years ago. I don't think that makes sense because the market today is such a different animal. It's, half of it is innovation and asset-light companies. 20 years ago, more than half of it was manufacturing. I mean, we're in a different ballgame here, so you can't just look at the S&P today and take that PE and compare it over time. So I would just caution investors that are bearish on valuation, that might not be the right framework to think about in this environment.
So to recap, guys, GDP keeps getting revised higher and earnings are rising to back up this rally in this market. A lot of people are hiding out in the AI stocks, which makes sense. She said the average portfolio managers have the lowest beta since 2008. And if you don't know what that means there's basically no bullish bets on the economy. She said markets are so pessimistic that no one's expecting an upside surprise. Margins are still holding for businesses. That's what's keeping the economy up. She recommends to stay clear out of healthcare, guys. It's the most government exposed. She said it's the most crowded sector and creates inflation. Today's market is so different than any other time in history that just 20 years ago, half of the economy was industrials, guys. And now almost everything is tech, soon to be tech AI. AI is a game changer that will accelerate the economy at a pace faster than we've ever seen. AI will eventually touch every industry and be a part of everything we do here soon. I'm happy to be investing in the beginning and can't wait to see where it goes. I hope you guys enjoy the video. Catch you in the next one.